Welcome to the Deep Dive. We sift through the noise to bring you the signal.
And today, that signal comes from Colgate Palmolive's latest earnings call.
Yep, we've gone through their results and what their leadership had to say. Our goal here is pretty simple. Give you a clear take on their performance and what might be coming down the pike.
Okay, so let's kick things off with a quick snapshot. Overall, Colgate Palmolive, they actually posted pretty strong profit growth.
Which is interesting, right, given how, volatile things feel out there.
Exactly. It wasn't all smooth sailing. They definitely flagged some challenges. A weaker consumer, not just here, but globally, and the impact of tariffs were big ones.
Okay.
But on the flip side, they talked up their strength. You know, their big global portfolio, different products, different prices. And they mentioned having a strong balance sheet.
So the general vibe was resilient, confident despite the headwinds.
Yeah, I'd say resilient is a good word for it. Prepared, maybe. Aware of the difficulties, but confident in their ability to navigate them.
Got it. Okay, let's dig into that weaker consumer piece you mentioned. You said global. What did they say was driving that softness?
Well, it sounds like a couple things playing together. First, just general economic uncertainty, making people maybe a bit more cautious.
Watching their wallets.
Right. And that led to what they call pantry destocking, basically. People using up what they have at home before buying more.
Makes sense.
And retailers were doing something similar, trimming their own inventory level. So kind of a double whammy on volumes in Q1.
But do they see any light at the end of the tunnel?
They did mention seeing some green shoots in April, signs that the categories might be starting to improve a little.
Okay, so maybe turning a corner. What's their outlook then, say, for the next quarter or the rest of the year?
Their expectation is that Q2, the second quarter, will probably still be a bit soft. You know, those trends don't just vanish overnight.
Right.
But they sounded, I'd say, cautiously optimistic about the back half of the year, thinking things might normalize a bit if consumer confidence improves.
And in the meantime, what's the focus?
It's really about the fundamentals, driving household penetration, getting their stuff into more homes, and just keeping their brands healthy. That's their long-term play for, sustainable growth.
Okay. Now, the other big challenge you mentioned, tariffs. Always a hot topic. Okay. What's the latest impact they're forecasting?
Yeah, tariffs are definitely on their radar. They're now expecting an incremental impact of roughly $200 million in 2025.
Wow, $200 million. Just from tariffs?
Yeah, specifically from tariffs announced since January this year. So it's a significant number.
And it sounds like it's still evolving.
Very much so. They called it a fluid situation, something they're actively monitoring, but they do have plans, short, medium, and long-term plans to try and mitigate it.
Okay, so what kind of mitigation are we talking about? How do you offset $200 million?
It's a multi-pronged approach. Things like looking for alternative sourcing for materials and even finished goods. Simplifying product formulas, maybe shifting production around geographically, and also using what they call revenue growth management. So pricing and promotion strategies.
Where's the main pressure point coming from? Which tariffs?
Seems like the majority of that impact relates to goods moving between China and the U.S., raw materials and finished products going back and forth.
Okay. Despite those headwinds, though, you said they highlighted strengths. What are the key opportunities they see?
Well, a big one is just the sheer breadth of their global portfolio. Having products at different price points helps them cater to consumers no matter their financial comfort level.
So they can meet people where they are, financially speaking?
Exactly. And they're actively tweaking promotions to do just that. Plus, being in so many different countries gives them that geographic diversification. If one region slows, others might pick up the slack.
Less dependent on any single market.
Precisely. And they also feel the work they've done building up their brand health over the last few years should really pay off now in a tougher market. People tend to stick with trusted brands.
And financially, they feel they're in a good position to keep investing.
Yeah, their P&L is strong, which allows them to keep putting money behind the brands and building capabilities. Advertising spend is actually at an all-time high, which is quite a statement.
Interesting. Investing through the uncertainty.
Right. And they specifically mentioned scaling up in AI, data analytics, innovation, the kind of future-proofing stuff. And like we said, the balance sheet is solid, low net debt, expecting strong cash flow.
Okay, let's break it down by region then. How did things look on the ground, starting with North America? You mentioned a slowdown there.
Yeah, North America definitely saw a category slowdown, particularly hit hard in February. But they did see some improvement in March and April, which is encouraging.
What's the game plan there now?
Focus seems to be on, well, innovation, getting the price and pack sizes right, driving productivity, and really scrutinizing the return on their advertising dollars. They expect things to improve in the back half.
And Latin America. How are things looking there?
Latin America actually sounded pretty constructive. Pricing improved compared to the last period. They're gaining share, both volume and value, in Argentina, which is notable given the situation there. And they've got pricing actions planned for Mexico and Brazil, too. So generally positive down there.
What about Europe? Often a strong point for them.
Absolutely. Europe delivered another really strong quarter. The drivers were premium innovation and consumers buying more of the higher end stuff, what they call positive mix.
Nice.
Strong pricing, market share gains, especially in oral care, Colgate, Elmex, Meridol. Those brands really performed well.
Okay, and Asia sounded more varied.
Yeah, Asia was a bit more mixed. China's market is still pretty soft, especially impacting their Holly and Hazel business, although the main Colgate brand is doing okay.
Right.
India also saw continued softness, particularly in urban areas. But other parts of Asia, like the Philippines and Thailand, were actually quite strong performers.
And rounding it out, Africa and the Middle East.
Generally pretty good market share growth across that region. The main exceptions were some volume softness in Turkey and South Africa, but otherwise, pretty solid.
Let's talk pricing and innovation. You mentioned pricing actions in LATAM. What was the overall picture?
Pricing overall in Q1 was pretty much what they expected. And if you look at it on a 2-year stack basis, it actually improved sequentially.
Okay.
But looking ahead, they do expect the pricing environment to stay, well, challenging, partly because of those tariffs we discussed.
So less room to just hike prices.
Probably.
Yeah.
Which means the focus shifts even more towards innovation as the main way to create value. They were clear they're not changing their innovation plans, might even accelerate some launches later in the year.
Across different price points, too.
Yeah, across the board. And they did see that positive mix shift in Q1, people buying more premium, which they see as a good sign.
Okay, let's zoom in on Hill's Pet Nutrition. That's a big, important business for them. How's it holding up against consumer pressure? Any signs of people trading down?
It's actually fascinating. They said they saw basically no trade down to private label in pet food. In fact, private label was flat to down in the US and Europe.
Really? That's surprising.
Isn't it? Now, they did see some trade down in toothpaste in North America, people maybe shifting from super premium to mid-tier, but not in pet food.
So Hill's itself performed well.
Exceptionally well. They reported 5% organic growth, and that's excluding private label in a market that was basically flat overall.
Wow. What's driving that?
It seems broad-based. Wet food, dry food, treats, cats, dogs, their prescription diet, science diet, all contributing. Strong investment, successful innovation, and really focusing on segments where they were maybe a bit under-indexed before, like wet food and cat food.
And margins.
Hill's had strong margin performance too, thanks to manufacturing efficiencies and that premium innovation paying off.
You mentioned private label. Are they still doing that in pet food?
They're actually phasing it out. They expect to be completely out of the private label pet food business by the third quarter of 2025.
Why the
Well, it'll probably hit their overall volume numbers slightly in the short term, but the upside is better margins, and it lets them focus entirely on growing their own brands, like Hill's.
Makes sense. Oh. Okay, what about advertising spend overall? You said it was at an all-time high, but any change in guidance?
Yeah, a slight tweak to the full year guidance. They now expect ad spend to be flat as a percentage of sales for the year. Previously, it was flat to slightly up.
Why the change? Pulling back.
Doesn't sound like a major pullback, more like a focus on ROI, getting the most bang for their buck and wanting a bit more flexibility in the P&L, given that category softness we talked about.
Right.
But they did emphasize that in local currency terms, advertising spend is still expected to be strong, likely up for the year, so they're still investing.
And connecting back to tariffs, you mentioned mitigation strategies like sourcing. Anything else they're doing to absorb that impact?
Yeah, beyond sourcing, they're really pushing productivity improvements across the board, just finding ways to be more efficient everywhere.
Standard operating procedure, but maybe with more urgency now.
Yeah, exactly. Plus using those revenue growth management tools, smart pricing, promotions, and leveraging the supply chain flexibility they've apparently been building over the last 5 years, including significant investments in U.S. manufacturing, which could help.
Interesting. Okay, one last area. Channel performance, particularly in North America. Where are people buying their toothpaste and pet food?
The trends here continue. Mass retailers think Walmart, Target club stores, and e-commerce are still the channels that are outperforming.
And Colgate's doing well there.
Yep. They said their market share is strong in those winning channels. The weakness is more in the drug channel and, to some extent, traditional grocery stores.
What about dollar stores?
They have strong market share there, and they actually expect things to improve as some operational issues those retailers were facing get sorted out.
And Hills Online. I heard something about Walmart.
Yeah, that's new. They've added Hills to Walmart.com, but interestingly, it's through a third-party distributor. They said the focus is on making sure the brand integrity is maintained online.
So, carefully managed.
Seems that way. And they hinted that if the online performance is strong, maybe, just maybe, an expansion into physical Walmart stores could be on the cards down the line.
Okay, a lot to digest there from the Colgate Palmolive call. Definitely navigating some challenges, but highlighting key strengths, too.
For sure, a complex picture.
All right, now for the part of the show where we step back and think a little differently. It's time for our This Is Not Financial Advices segment,
where we float an outrageous but plausible trade idea based on the discussion. Go on, what have you got?
Okay, how about this? Given everything we heard about the strength of branded pet food, especially Hills, and Colgate exiting private label to focus on premium, maybe the play isn't Colgate itself, or even just pet food makers.
Okay, where are you going with this?
What about the companies that support the premium end? Consider a long position in, say, specialized packaging companies that cater to high-end pet food brands.
The picks and shovels play. Interesting.
Exactly. If the trend is toward premium, innovation, maybe even more complex formulations or formats in pet food, those brands will need packaging that reflects that quality, protects the product, stands out on the shelf, maybe has sustainability features.
So you're betting that as Colgate and potentially others double down on premium pet food, the demand for sophisticated brand-enhancing packaging goes up.
Precisely. It's a bet on the resilience of pet spending, particularly at the premium end, and the infrastructure supporting it. Disclaimer, obviously this is not financial advice. Always do your own research and maybe talk to a qualified financial advisor before making investment decisions.
A creative angle on the premiumization trend in pet care. I like it.
Well, that brings us to the end of our deep dive on the Colgate Palmolive earnings call. We've unpacked the results, the headwinds, the bright spots.
Hopefully giving you a clearer picture of where the company stands and what they're looking towards.
What stood out most to you listening in? Any questions still lingering? We'd always encourage you to dig deeper yourself. Thanks for tuning in to the deep dive.
Join us next time as we tackle another key earnings report.